So there are 6 reasons why we launched the Ethical Fund. And when Ron, our CEO, started talking to me about the Ethical Fund over 6 months ago, you could have coloured me skeptical as well. The last time I'd heard so many people talking about ethical funds was back in 2006. And my cynical view was that at the time everyone was feeling very wealthy and therefore everyone wanted to feel good about it. But the more and more I looked into this and the more the facts actually lined up, that there's a really important reason to be thinking about these factors, and that's because these ESG or ethical factors are becoming increasingly risky to a number of businesses. And the 6 things, or I guess the themes I'm going to talk about today is that, first of all, don't think you need to think about having lower returns in your portfolio from sticking to what are considered ethical stocks, or at least ESG compliant stocks. So that's really important. I think also there are increasing risks for businesses that aren't ticking those ESG boxes. Third, with the approach of this fund, it will be the same as the same tried and true intelligent investor approach that we've used for almost 20 years now. The long history of outperformance, and I'll briefly touch on that as well. Also want to make the point that ethical businesses tend to be superior businesses, and that really comes down to a lot of the businesses that tick the ESG boxes tend to be in the sunshine industries compared to most of the businesses that don't tick those boxes tend to be in sunset industries anyway. Second to last thing there is ethical is actually becoming the norm, and I think in 5 years' time we won't actually be talking about ethical or ESG factors as a risk. They'll just be a normal part of the investment process. And the thing that matters most of all to you is that to invest in this portfolio is easy. So when Ron and I first started talking about this portfolio, the first thing that came to my mind, and it's the same thing I think that comes to most people's mind, is that what am I going to have to give up in return to invest successfully in an ethical fund or a fund that ticks these environmental, societal and governance factors, or ESG factors. And so if you have a look at basically any fund manager that offers this type of fund, they always pull out these same set of numbers. And it's a little table from an organisation called the Responsible Investment Association of Australasia, and they've measured the performance of the average responsible investment fund over the past decade and compared that to the average large cap Australian share fund average and also to the index. And so what you see there is on the right hand side, you'll see, and bearing in mind the numbers are so low because this really incorporates the worst of the tail end of the GFC, and the average responsible investment fund has done almost 2% better per year compared to the average large cap Australian share fund. And we all know from history that nearly 2% average outperformance over a year over a very long period amounts to a huge amount of extra money in your pocket. And you can see there also compared to the accumulation index, which, as you're probably not surprised, has outperformed the average large share Australian cap fund, has done better than 1.4% per annum. So whether you're looking at a comparison of peer funds or whether you're just looking at the index, the last 10 years has clearly been very good for the average responsible investment fund. The problem I have with these numbers is that it only covers a fairly short period, and that short period really does coincide with the longest bull market we've ever had in history. And it's not the strongest bull market we've had in history, so the returns haven't been the highest, but it's been the longest. But the problem is that's really only going back 10 years anyway. And in that period, what we've seen, particularly over the past few years, is that a lot of the stocks that fit into a responsible investment fund, so think about healthcare stocks and software companies, have been absolutely incredible performers. And my guess is that when we go through a full cycle, we'll find that a lot of the valuations that these companies sport today aren't going to be sustainable. So I think we've just hit on a really, really good time for the average stock that would be a typical holding in some sort of responsible or ethical fund. So I thought to myself, is there anything else I can do that might actually give me and us a better idea of what sort of returns you should expect from a fund from the InvestSMART and Intelligent Investor House? And also, is there something that provides us with a longer period which would actually just give you more confidence in the numbers? And so I thought that the most obvious thing staring me in the face was that Intelligent Investor has around 420 buy recommendations going back to 2001. And I was there for 10 years of those, and I've been back here over the last 7 or 8 months. So for more than half the period of Intelligent Investor, I've been a staff member and been involved in a lot of those recommendations. So those recommendations should give you a very good guide as to what sort of returns we should be able to produce for you. So what I decided also was to go back through those 420 recommendations and look at our ESG filter and see which buy recommendations would pass and which ones would fail, simply based on the negative screen that we are going to apply through our fund, which is something I'll talk about shortly. And so what I found was that the average return from the companies that passed the ESG filter was the average annualized return was 14.8%. And compared to the 60 recommendations, so there was 360 recommendations with an average of almost 15% annualized return, the average for the other 60 companies that wouldn't have passed the ESG filter, the return was only 10.1%. So that was an almost 5% gap in annualized return between the stocks that would have passed our ESG filters. And so to me, that was really a light bulb moment that showed the way we invest, we know it works over time. But also, I just think it goes hand in hand with these ESG filters, because what we're trying to look for is companies that can compound their returns for a very long period of time. So if we buy right, then the hardest bit then just becomes to hang on. But what happens when you think about some of the companies that don't pass the ESG filters, and we'll talk about those shortly as well, but companies like resources companies, they're just far more difficult businesses anyway. If you were got to choose between being the CEO or CSL or BHP, I know which one I'm going to pick. Right, CSL is the leader in its business. It doesn't have to reinvest all its cash flow into new ideas or into digging holes like BHP does. It's very risky, the sorts of projects that BHP does. And so even though BHP is one of the greatest businesses for a resources company, in many respects, it's a much poorer quality business compared to the average industrial business, which tend to be the sorts of companies that are bought in an ethical fund. So to me, this was a revelation, and this is when I started to get very serious about what we can offer you in terms of a fund. So this slide is all about the increasing risk for unethical businesses or businesses that just don't tick the ESG filters. And we've seen things like the Hayne inquiry for recently in the financial services industry, but there's actually a whole bunch of individual things that I think people see that apply to individual companies or individual industries and just don't really think much more about it. But if you actually look at a whole bunch of different things that are happening in different industries, and you actually sit back and you realize all these things are actually tied together, and they're tied together by essentially not passing these ESG filters. So my really strong view to anyone that's investing, and regardless of whether you want to invest in the fund or not, if you're not thinking about these factors, then you're putting your portfolio at undue risk, because these ESG risks are only going to increase from here. And the fact is that whether it's from increased competition that have got new services or superior services that are seen as more environmentally friendly or more in tune with modern societal attitudes, or if you've got these are the sorts of companies that people actually want to invest in. And if you're on the wrong side of that, then either that new competition, or in the case of something like the Hayne inquiry where the government gets involved, either of these forces is going to expose those businesses and reduce profits and reduce dividends. And as I said, we just can't afford, in a market like this where the market's probably priced in about an 8% return at best, I would say at the moment, we just simply can't afford to be taking these unnecessary risks in our portfolios. So the Hayne Financial Service Inquiry is probably the most well-known recent inquiry into the financial services businesses that exposed all the really, really abhorrent behaviour in the banking and insurance industries. And so it's not actually the banks or insurance companies as an industry that's necessarily unethical in the way it acts, but it just certainly the culture that is being put in place in these businesses has encouraged that bad behaviour. And what we've seen out of that has been, in many ways, I think, disappointing. In what we've seen, we're starting to see banks now offering 10-year interest-only speculative investment loans. So that really wasn't the sort of behaviour you want to see coming out of the Hayne inquiry. But what it did do was that a number of CEOs lost their jobs, and now we're seeing payments or refunds to customers, and hopefully this is going to set the tune for far better culture in these organisations. But for anyone who's got experience investing in the stock market, you'll know that culture is probably just about the hardest thing to change in the business. So whether this just all falls flat over the next year or two, or whether over the next 4 or 5 years we genuinely do see a change of culture for the better and for all stakeholders and not just trying to boost short-term profits for management, remains to be seen. But next, after the Hayne inquiry, we're seeing the aged care inquiry. So again, any of these companies that are caught in the ESG crossfire or this ethical crossfire, the government's coming after you. And so what that's ultimately going to mean in most cases is lower profits and lower dividends. And a good example with the aged care inquiry is that regardless of what the ultimate outcomes are, we're highly likely to see higher staffing levels within these businesses. There was crazy stories that you might have seen on Four Corners last year where one nurse was saying that she had 30 minutes every morning to get 6 elderly people out of bed and washed every morning. And that was just absolutely ludicrous when you see what sort of physical condition most of those people are in. To barely get them out of bed in 5 minutes is a challenge, let alone get them in the shower and washed, dressed, and back into their beds. And all the while they're supposed to be feeling good about they're being looked after. And so this was just crazy. So even if it's not actually people acting illegally or really trying to do the wrong thing, it can be just much more subtle than that. It can just be that the staffing levels are too low, and once that gets fixed, there'll be better service, which is what it should have had in the first place. But ultimately for investors, it could potentially mean, particularly in the short term to medium term, lower profit margins until the companies work out a better business model. So you absolutely have to be aware of this stuff, even if you're not necessarily a big buyer into these ethical factors. We're now seeing a huge push into renewables to replace fossil fuels. So even if you're living in Queensland and you don't agree with the coal policies that are affecting that state in particular by the government, the fact is the government's got a very anti-coal lessons in its policies at the moment, and so you don't want to be on the wrong side of that as an investor, although some people would tell me that this is actually potentially an opportunity in coal given how low the expectations are for a lot of share prices. But the fact is these aren't great businesses for the long term anyway. Looking at Coca Cola, which is a company I like to use as an example, and the reason I like it is because anyone who's followed value investing or Warren Buffett for a long period of time, you know that he is probably his most successful investment in many regards financially, but also it's just the most well-known example of a very large investment he made that made a lot of money starting in the late 80s. Warren Buffett would always use Coca Cola as an example of what is arguably the best business in the world. And so his idea of the best business is basically one that every 12 months can put its prices up and will have no impact on the way people think about that product or the number of times they'll use it. And so he'd always say with the can of Coca-Cola every year, they can put the price up by 1 or 2 or 3 cents, and it's not going to make any difference to whether we buy that can of Coke or not. And so that was his example of a great business with distribution all around the world. There's basically just about nowhere you can go in our world and not find a can of Coke. So what happened more recently is that societal attitudes towards fizzy drinks that are full of sugar has changed. And in a number of countries, they've either put in or have contemplated a tax on high sugar cans of Coke and all sorts of other products. And so again, this is undermining the profit margins of Coca-Cola. Now, Coca-Cola's management was quite smart in that they saw this happening and they saw the change in consumer tastes before it really took hold. And so intelligently, they started selling us bottled water. But what is the problem with bottled water now? It's the environmental damage that the plastic containers are doing. And so now there's a real crackdown on people buying bottled water and really trying to advertise and promote other ways when you can get your water for free. And so again, it's another hit to this business. So what used to be one of the greatest businesses in the world is no longer one of the greatest businesses in the world, and it's being challenged on a number of ESG fronts. One of the greatest things that I've seen more recently in regards to governance has been increasing shareholder activism. And with things like technology and just more people paying attention to their businesses, I think this is only going to increase. And one of the most amazing things I've seen in my career so far was more recently when Andrew Thorburg, who was the CEO of National Australia Bank, he was the CEO for 4 years, and when he and the board, the chairman of NAB, were recently ousted from their positions, normally Andrew would have received the golden handshake, which is typical of these situations. And for the first time in my experience, there was $22 million of vested shares in National Australia Bank that would have automatically flowed to Andrew Thorburg, and he didn't get them. The board said, you haven't performed over the last 4 years, you don't deserve them, and so you didn't get them. And I thought this was absolutely brilliant. And this is complete contrast to Mike Smith, who was the CEO of ANZ, who had the idea that he was going to expand ANZ into Asia, which in my view, or our view at Intelligent Investor back then, was extremely risky, because ANZ is not 1/4 of an oligopoly, a regulatory sanctioned oligopoly in Asia. So the returns were never going to be anywhere near as good as what they are in Australia. But the board was on board, and I used to get criticised all the time when my view was always to buy CBA and Westpac and Macquarie Group, and don't worry about ANZ and National Australia Bank. And the main reason was because they'd gone overseas, they'd blown up a lot of money, and they didn't have the biggest scale in the market. And that can be very advantageous in a downturn, because the banks with the most deposit holders can raise money the quickest. But aside from that, in December, there was an 85% vote against the remuneration report of National Australia Bank. So when you see that, is it actually any surprise that a couple of months later that the CEO and chairman were gone? So increasingly we're seeing shareholder activism, and I think that's an absolutely great response from investors, and it gives small investors like us a hope too, that when a much larger organisation than us that has billions or hundreds of millions invested in companies, they can actually get these things changed as they should, because we shouldn't be rewarding CEOs for bad performance. And the last point on this slide is that the millennials are becoming much more socially conscious. So it's not just the old days about avoiding tobacco stocks or alcohol stocks. There's more to it. There was a study done last year, I think it was about 12 months ago, in the US. And what's really made America stand out, and really why they're the hegemon of the world, is because they've had this capitalist economic system that has just worked absolutely tremendously. And people look to America as to essentially emulate what their capitalist society has done. Now, interestingly, the study done of millennials last year showed that 64% would prefer a more socialist economy, which was just absolutely incredible in my eyes. But it's not actually surprising when you see that 2009, the GFC, when TARP and quantitative easing was essentially a socialist policy that rescued a lot of, under the guise of rescuing a lot of other people from financial despair, but in reality all it did was make the rich richer and the poor poorer, and hence why we've got a lot of protests today. And I think an increasingly societal issue is the gap between the rich and poor. And so it's hardly surprising that millennials want to see a more socialist economy. Now, they may not be today's investors, but over the next 10, 15 and 20 years, they are going to be the senior managers of the companies we own. So it's very important to see what sort of attitudes they have to different industries, because they are going to, in fact, impact the profits. So I just thought I'd just talk very briefly about the intelligent investor approach. I've got this quote here from Jesse Livermore. There's a book that's essentially about him called The Reminiscences of a Stock Operator. And he was around in the 30s, and he made and lost 3 or 4 fortunes. And ultimately, he ended up committing suicide in, I think it was his early 60s. But he actually had long-term investing sorted out almost 100 years ago. And he said, it was never my thinking that made the big money for me. It was always my sitting. And I know as a fund manager, the most difficult thing is to actually sit there and do nothing. And yet 99.9% of the time, the best thing that I can do for your portfolio is to make no changes to it. So the idea is to buy right first, and then just let great companies, and use CSL as a good example. I recommended that back when I think it was $32 in 2010. And I actually thought if in the near to medium term, if it got to $40, that would be a pretty good outcome. And yet here we are 10 years later, and it hit a high of $240 a year or two ago. It just shows you can really undervalue the great businesses and the compounding of those earnings. But if you buy right and you buy good businesses, then the surprises over time tend to be good ones. And that's in contrast, you buy the challenged but deeply discounted business, and usually the surprises you get from those ones tend to be all bad. So the basic framework we use at Intelligent Investor is we're looking for high quality businesses. Something that's really, really important to me that I'm going to talk more about specifically in a moment is high insider ownership. We want companies with long growth runways, because the price you pay now to be on the wrong side of technology is potentially a company going to zero, and very quickly. And as usual, we're cheapskates. We want a large discount to intrinsic value. But I think in a market like today, you have to be quite pragmatic, and you're much, much better off to buy quality at fair value than you are to be taking larger risks with deeply discounted stocks, because fund managers have been looking over and over, even the small areas of the market, and if they've left these small stocks behind for some reason, then you're pretty much guaranteed in the current market environment that there is something genuinely wrong with the business. The other group of stocks we tend to look for are things which go under the banner of special situations. So sometimes a new CEO can be an absolutely great change for a business. An old, poorly performing CEO goes out, a new CEO comes in, and he rejuvenates the business, and he makes a lot of tough decisions that the previous CEO wasn't prepared to make for some reason. And the recovery in the share price over time can be absolutely amazing. We look for businesses that have been recapitalized. Often companies run into trouble for all sorts of reasons, but often the new CEO comes at around the time of a recapitalization. So normally I used to think about a recapitalization as a business that wasn't able to fund itself and was actually probably a poor company because it couldn't do that. But often what you find is there are different reasons why a business needs new money, and actually can be a great time to get into the stock, because that's when the existing shareholder base is at its most disappointed, because they've lost a lot of money, they don't want to give the company any more money, they've been diluted from the capital raising, and they just want their money back and want to leave, which leaves the share price essentially trading in a vacuum and potentially trading well beneath fair value. Another form of special situation which is becoming more common in Australia are spin-offs. South32 was a tremendous spin-off from BHP, but there have been loads of others. We've seen Coles spun off from Wesfarmers recently. And if you look at the research, it says that modern day spin-offs don't tend to, so in the old days, probably up until 10 years ago, you used to just be able to buy every company involved in a spin-off, so both the parent and the company being spun off, and you would have done exceptionally well. The research these days shows that 6 out of 10 do really well, but when they do work out, they do really, really, really well. So the idea is now you've got to try and pick those 6 out of 10 that are going to work out and try and avoid the other 4. And the last one is hidden assets. And this is one that you may have seen particularly in the last, I guess, 3 or 4 years. We're seeing a lot more fund managers using artificial intelligence or more computerized trading and stock picking methods. And I think what this is doing is it's the companies that tick all the boxes when they have a good update. So for example, if they've got a commentary about their last 6 months of performance and they find 80 positive words in that transcript, they'll see that as a buy signal. And so what you're seeing now is a lot of stocks trading on very high valuations, but because there's a lot of momentum in the earnings of the business, and then that's reinforcing the momentum in the share price, which is making life difficult for value investors that are trying to buy on the cheap. But something that artificial intelligence can't do is find hidden assets in a business that aren't coming through the earnings or the net income statement easily, something that can't be easily measured. And so the example I've picked that I'm going to talk about later on in a little bit of detail is a company that I believe has a hidden asset right now that an artificial intelligence program simply cannot pick up. So this here is about having skin in the game, or having the managers or the board members who run the business having their own money invested in the business. And this is why, to me, the best governance you can possibly have is shareholders with or managers with skin in the game. And the reason is because it's their own reputation and their own money that's on the line. And what the left-hand side chart here shows you is it goes back to 1990 and it only goes to 2014, which is important for reasons I'll explain in a moment. but it compares all the companies in the S&P 500 in America, and it compares the average return from the founder-led companies to every other company in the S&P 500. And you can see it's almost a fourfold return compared to the other companies for the founder-led companies, which is just an absolutely enormous discrepancy. Now, the question I'll put to you is, if I had this chart from 2014 to 2018, imagine what it would look like if all the technology companies in America that have really driven the market, think about Amazon, Microsoft, Netflix, Amazon, Google, all these companies are founder-led companies. So that chart would look even more ridiculous if we were able to get it up to 2018. Now, the chart on the right-hand side, you don't need to know in any detail, but what it says is that it's not just a technology industry or this point in the market type phenomenon. It's actually across all industries, and it's not just America either. If you go and jump onto Google and look at for the same type of information for Europe, you'll find a lot of dynastical wealth where businesses or that transgenerational wealth has been passed down through many generations, and it's the same. They've just got this outperformance over the market, and it's just to do with things like management thinking about what this business is going to look like in 10 or 20 years, rather than being the Mike Smith type of corporate CEO that comes in with a tails he wins, heads he doesn't lose policy of taking risky chances in overseas markets. So again, this is a really important phenomenon to us, and regardless of whether we're buying an ESG compliant business or not, this is always going to be an important part of our process. This is what happens when you don't have managers with skin in the game. And we could actually do a whole webinar for about 3 days, I reckon, of going back through the big corporate mishaps in Australia. But it's just unsurprising when you see these sorts of headlines, and it's because the CEOs and boards of these businesses are rewarded for short-term gains at the long-term expense of the business. And these aren't just bad necessarily investments. These are just very unprincipled and shameful actions by boards and executives. It's just untenable. And the fact that these sorts of people get paid out golden handshakes on the way out for absolutely atrocious behaviour has got to stop. And that's why I was so encouraged about Andrew Thornburg's departure without that $22 million in shares. And I don't think enough has been said about that. Now, obviously, this slide's not going to go down too well in Western Australia, but I just tried to pick 2 companies that both are seen as the best companies in their industries, but just to talk about why one just has a much easier future than what the other has. CSL has been a tremendous stock for a long time now, and it's widely regarded as Australia's best business. But the way we tend to look at business is we look at the return on equity. So this is essentially the return that a company gets for investing $1. And so the return on equity for CSL is up in the 30s, I think, at the moment. And BHP's has jumped all over the place over time, depending on where it is in the cycle and the prices it's getting for its products. Now, BHP and Woodside and Rio have all found religion at the moment, and they're returning a lot of money to shareholders, which is something they haven't made their legacy from. Now, that's absolutely great, but at some point, these companies are going to have to invest more to expand their operations or to increase future sources of earnings. They're in a real great spot at the moment because the price of iron ore has been increasing, but that's never going to last. And if you just think about CSL and BHP's financial characteristics, you see that CSL produces a lot more free cash flow over time. So that means there's more money to invest in new ideas or new research and development, and more money to return to shareholders. And also the consistency of those profits and dividends has been far superior over time. And as I said at the start of the presentation, if I was asked to be the CEO of CSL or BHP, I would take the CSL job any day. It's just the dominant player in its market, and its future and pricing power is all far more assured than it is for BHP. And yet BHP, for a resources company, is absolutely tremendous. But one company is just a lot easier to run than the other, and just has a lot easier decisions to make. And I think that's the case for resources companies generally compared to good industrial companies. And if you see the companies that tend to tick the ethical or ESG boxes, they just tend to be very good industrial businesses anyway, which is the ones we prefer to buy. This slide is all about ethical becoming more the norm, and as I said, I think in 5 or 6 years we're not even going to be talking about ethical funds. I think we're just going to be talking about it as a normal part of our investment process. And management has always been really important to us at Intelligent Investor, which is why I talked about we much prefer having management or backing businesses where management has skin in the game. It just completely changes the way they run their businesses and how they think about running their business for the next 10 and 20 years rather than the next 3 or 4 years to maximise their own bonuses. But we're seeing changes in societal attitudes, and again, we're not just talking about things like smoking here, but just a general, we're seeing a much more, we want to see our businesses doing better by all stakeholders, not just shareholders or not just management getting rich at shareholders' expense. Companies have got to be doing the right thing by everyone in the community. We're seeing increasing pressure on governance, and that's only going to increase. And there's actually a whole bunch of new companies and organisations that are forming just to fight these battles. So that's a great thing for having a more sustainable business sector in Australia and the world. Reducing risk is just good business. So if you're seeing the CEO of a business who's just not even thinking about any of these ethical or ESG factors, then to me they're being reckless as managers and they're not doing their job by you as shareholders. They should be absolutely on top of these risks. They should have policies for them. They should be well laid out. They should be monitored and reported on every year. And so it's a real red flag if you're seeing companies that aren't showing that sort of stuff in their annual report. Interestingly, we're seeing, I think one of the considerations for investors when they think about investing in an ethical fund is that, well, isn't that going to severely reduce our choices? But what's interesting is we're actually now starting to see a lot of companies who see themselves as not potentially ticking some of those boxes, trying to make moves that will actually see them tick those boxes. And Woolworths considering selling its pubs to get rid of the pokey exposure is just one of those examples, and I expect we'll see more of that over time. And one of the most important things that you'll see in looking for these ESG factors in an annual report, and what will actually genuinely drive changing behaviour or improve how a business is run, is when these things are measured and impact a management's remuneration. And I've just used Dulux as an example there. Dulux uses a lot of products that are very dangerous environmentally, that can be very harmful. But if you go through its annual report, there's pages and pages of how they measure this stuff and talking about anecdotes about how important this stuff is to them on a daily basis out on the factory floor, what they're doing to manage the risks, and 10 to 20% of management's remuneration is on these ESG and environmental factors. And I guarantee you won't see change in these businesses until management's remuneration is impacted. And so it's great that more companies are taking this into consideration. So what's in it for you? So it's an active ETF. So basically what this means is it's a fund that you can buy and sell on the market just as you would like a regular stock. It will trade at net tangible assets. So it's not like a listed investment company where you go through cycles where you can potentially buy them at a big discount to their underlying net tangible asset value. But a lot of the time they trade at premiums as well. So you won't be overpaying for the portfolio. You'll just be paying for what the fair current market value of the portfolio is. And as I said, you just buy it and sell it like a stock, and it's a ready-made portfolio. So we have to do the hard work to keep the portfolio performing over time and make sure we've got the right stocks in there. But all you have to worry about is just buying the stock like you would normally. I've talked about it's the same intelligent investor long-term approach, and nothing about that is going to change. We're focused on high-quality businesses, and as much as possible, we try to hang on to our great businesses because it also helps minimise tax. And as I've talked about, what we find through history is that a lot of the activity by fund managers is pretty useless. So the best idea that we've got is if we just buy right in the first place and hang on and stay out of our own way, then that's the best way to maximise your returns as well. There'll be semi-annual distributions. Just keep in mind this is a growth fund, so it's not targeting distributions. There'll be the same regular reporting and candid communication that you expect from us anyway. For anyone that's fairly new, either to myself or to the funds, active funds at InvestSMART, please feel free to go through the quarterly and monthly things that I've written up, reports that I've written up. I try to put a bit of effort into them and just explain the companies we own, why we own them. And I've been back on board now for 6 or 7 months. So you can see that a lot more commentary now and about how the funds are progressing. And as always, if you've got any questions, you can always ask me anyway. And the last point there is there's a management fee of 0.97%, so just under 1%, but there is no performance fee. So for anyone that recently attended our roadshow and seminars, Alan and Ron talked about how much damage is done to your returns by fees, and they also talked about the flat fees in our ETFs. This doesn't have a flat fee because it is a listed fund and we can't charge every investor individually, but we only have the management fee. So hopefully as we outperform over time, essentially all that outperformance is all yours. And that's essentially where most funds generate all their revenue from. As anyone who might have owned Magellan or the headstock for Platinum Funds Management will know, that's really where the juice is, but we just have the fixed management fee. So when you add up all the fees overall and including performance fees, are actually quite cheap compared to just about all the active funds out there. So this is just one example of a stock. This is called 360 Capital. We've been running in the background the ethical portfolio for 3 or 4 months now, and we've also got our growth and income fund, and this stock appears in all the portfolios. I haven't picked it because it's particularly ethical compared to the others, but to me this is just a good example of the sort of value you can find even when we're deep into a bull market, and it also highlights the idea of hidden assets that we're not paying for. And so although a lot of active managers haven't outperformed over the last few years, and even intelligent investor funds are only roughly around the market average over the past 3 or 4 years, I think one thing that the fund hasn't had a lot of, and what we need to have a lot more of, is owning these small types of businesses that start out small today but become much larger over time, and we can just hang on to them as they grow. So we're not a small cap fund, so we don't have to sell them when they get to $1 billion of market value or anything like that. And we're not running billions of dollars either, which means we can be very flexible about the size of the companies we can invest in. So we're not going to be a micro cap investor, but what we want around the great blue chip businesses that we've got, where there's lots of founder owner managers, companies like Seek is a good example. What we're trying to find is the next generation of future Seeks, and 360 Capital to me is a good example of this. So you can see there's a chart of the share price for the ticker is TGP, but it's called 360 Capital. And I actually owned this stock personally back in March 2009. It was called Trafalgar back then, but it was the same ASX ticker. And I thought I did exceptionally well when I hung on for about 18 months from that sort of around March 2009, made around 80% in a fairly short period. And the reason I made that money was because a guy called Tony Pitt basically took control of the business. And you may remember that coming out of the GFC, just about all, I'm pretty sure all A-REITs at the time were trading at a big discount to the net tangible value. And a lot of that was because you didn't know how much debt they were going to, how much equity they were going to have to raise, because they had too high debt levels and they needed to bring those down. Otherwise, the banks were going to step in. And so this Trafalgar at the time owned a lot of B-grade properties. So this is not your, your A-class office properties in the middle of Sydney or Melbourne, for example. These were more suburban or just B-grade type office properties, and they tend to perform the worst in during recessions. So probably a good thing to keep in mind if you're invested in that sector at the moment. Now, what he did, he said, I'm going to come in, we're going to get the vacancies up, occupancy up in these in the portfolio, we're going to hike the rents, and we're going to maximize the value of the individual properties, and then we're going to sell them at market values, and we're going to bridge that or eliminate that gap to the net tangible asset value. And he did that, and he did that fairly quickly. So he did exactly what he was going to say, and he had his own money on the line at the time. Now, back then, the best thing you wanted when you're coming out of a recession, particularly in property, you want to own the equity in these portfolios, because that's where you get the biggest bang for your buck. But at this stage of the cycle, very late cycle, you actually want to own as much of the debt with as many covenants managing that debt as possible as well. Because what that means is that you have, if something goes wrong with the development, that effectively you can step in and sort it out with all protections of people putting their homes down as collateral, or other businesses or other property. And so you've got a lot more to work with. You've just got a lot more protection with your investment. And so what we've seen recently is that the big banks, after the Hayne inquiry, have been pulling back their lending. And so if you're a developer and you want to build just say a $15 million or $20 million doctor's office in suburbia, the banks really aren't wanting to fund those sort of investments at the moment. They feel like their books are full of loans and they really just want to minimise risks, and potentially with house prices still falling, they're just trying to minimise the risk they're taking on. And we've actually seen a number of property schemes, is the right word, of banks actually trying to switch some of their customers to other banks to lower their risks. But what's happening is basically you've got the banks pulling out, and that's produced a wonderful opportunity for smaller companies like 360 Capital to provide funding. So at the moment, 360 Capital has essentially turned its strategy on its head. It's basically a cash box right now, and it's just selling the last of its properties. And now, rather than being just a regular A-REIT, it's looking to provide money into developments, smallish developments that have got very high returns at the moment because there's a lot less competition to provide finance, which is great. And the other thing that Tony Pitt is doing is he's trying to create a funds management business. So at the moment, the stock basically trades around the net tangible asset value of the business, which is essentially all cash. And there's a recent presentation from the company that laid out a number of developments that they're looking to work on. And they've announced that they're going to launch 3 funds. So at the moment, you're paying absolutely nothing for whatever the future value of this funds management business is. Now, even if the funds management business doesn't work, and say in 3 or 4 years, Tony comes back and said, look, we gave it a shot, it didn't work, you're still going to get whatever return he generates from the regular business by investing in these developments. And I expect over time, through a full cycle, just as Tony has shown in the past, that you'll get an excellent return from today. But on top of that, what you're getting is this potentially extremely valuable option for this funds management business that could be valued over time at more than what the business is currently valued at, and you're not having to pay a cent for it. So this is not the sort of something that artificial intelligence can go and deduct from going through annual reports. This is something where you actually have to do the analysis. And I don't know whether this is going to be the one that goes up 4 or 5 times or more over the next decade, or whether things may not work out and we'll just get hopefully a more like 10 or 11% return, which would be more typical of an A-REIT starting in today's position. But it's just a case of tails we win big and heads we shouldn't lose too much, if anything. And they're the types of investments we're looking for. If we can find 20 of those and put them in a portfolio, then we know we're going to do very, very well over time. And this is a real advantage we've got at Intelligent Investor, and something we need to do a lot more of. So with that, I'm just going to quickly hand it over to Sophie, who's just got a little bit more detail about the offer, and then we'll look forward to your questions.
Okay, so the initial offer will open on Monday the 29th of April with the expected listing date of Wednesday the 12th of June. If you would like to register your interest or to find out more, please visit www.investmart.com.au/INES. And we only have a few questions, so if you do have any questions, send them through. This one's from Jamie. She said, regarding governance, the banks have had to comply with ASX governance requirements, but obviously have failed. Also, why aren't more executive remuneration policies focused on long term, i.e. similar to a trailing commission approach? Thanks.
Question. Why aren't the incentives more structured to the long term? I think that's a great question, and something that came out of the GFC was that they talked about, because a lot of it was the financial organisations, particularly like the trading houses and the big investment banks, that went bust and basically took down the financial system with it. And the ultimate question out of that was, why did they get such huge bonus payouts every year, and yet it had no reflection on whatever future problems that were going to be generated by the businesses they worked in. I can't answer that directly. I think the problem is that if you want to attract the best talent and you've got a superior bonus structure that's more shorter term and means it's just going to be a higher amount of dollars for them in a shorter period of time, that's the more attractive job they're going to take. But you're absolutely right. There needs to be more of it. And every time I hear there's going to be more talk about it, it just never becomes a big thing. And really, particularly when you're running a bank, and particularly when you're running a regulatory sanctioned bank like Australia's, the fact that you can earn $10 million being the CEO of that bank, astounds me, first of all, and the fact that your total payouts don't vest over periods like 5 or 6 or 7 years that include a full market cycle, which is really important for banks who have had absolutely rapid credit growth over the last 10 years since the GFC. If you're the CEO in that early period just making all the loans and none of them are going bad yet, then that's great for you, but those decisions you're making are going to have an effect on the bank for the next 15 or 20 years, and you should wear some of the cost for that. So unfortunately, we're not going to be able to change that on our own, but it's absolutely the right question to ask. And in terms of the first one, part of that question about ASX has had a lot of these guidelines for companies, and that hasn't changed anything. It comes back to what I think is a really important point, and some people have suggested to me that what they would like is essentially what amounts to a box-ticking exercise with management. So you can go through and you look at management and you look at all the different parts of their remuneration structure, their strategy, and essentially what you do is you tick a box, and maybe at the ends, if you've got to made it a little bit more complicated, you have some sort of scoring system perhaps, and companies will go into the portfolio if they hit a certain score or if they tick those boxes, and the ones that didn't tick the boxes don't go in. Now, the problem I've got with that is that, and this is why I don't ever want our investment process to become box ticking, is because one of the problems when you've got a lot of founder-led businesses is that I think we have to understand quite pragmatically that often that they're an entrepreneur, they want to make decisions quickly, and they don't really want the board to interfere with them a hell of a lot. And so it's very difficult to, even when they say you've got an independent board presence on these businesses, the fact is it really is the chief executive that runs the show. And often what you'll find is that they don't necessarily have the full quantum of women on the board that people would like, and don't have enough independent directors. Now, if we just made that a box-ticking exercise, then a lot of these great businesses where these entrepreneurial CEOs with their own money on the line that have created huge amounts of wealth for themselves and their shareholders, we wouldn't be able to invest in them. So for me, it's about weighing up all the factors, all the risk factors under all the governance and environmental and societal and all these additional things, and coming to a conclusion about a business. And I don't ever want this just to be a box-ticking exercise, because I think what you're going to end up with is far inferior results and probably just picking on one small component of a much larger problem, or just a lot more issues that are more meaningful to the investment outcome. But it's absolutely a great question, and for whatever part we can play in changing these incentive structure in the future, we will.
Okay, we have a question from Aaron. He asks, will you be investing in this fund?
Yes, I should have actually had this on the slide. I will be investing in the fund. I believe Coca Cola is also committed to investing in the fund. I would never manage a fund that I was prepared to put my own money in. I've even got money in our income fund, and I'm only 43, so I'm not really looking for the dividends yet. I'm more interested in our performance over a long period of time and finding as many great growers as we can. And not just, I don't really want this fund to be something that just outperforms by 1 or 2% over time. We've got the size of the fund is never going to be in the multiple billions of dollars, or at least not for a long time. So we've got these great advantages to find tomorrow's winners to go along with the CSLs and Cochlears and these big blue chip wonderful businesses. And so I really hope through a full cycle that we can actually deliver our performance more in the line of 2 or 3% or more. Now, I can't promise I'm going to do that, but I just think the advantage we've got of being able to find these smaller companies and hold on to them for the long term to become big winners, I just think that's an advantage that we really haven't done brilliantly with yet. And obviously it's going to take some time, and you'll see with the growth portfolio that I also manage, there's going to be a lot of crossover between the stocks, so you get a sense of a lot of the stocks that are in there are going to be in this ethical fund as well. So companies like Frontier Digital Ventures, which if things work out the way I hope they're going to work out over the next 5 or 6 years, could be worth 5 or 6 times more than what it is today. And now it's obviously easy to talk about the prospects. You don't know how these things are going to go, but if you can just find half a dozen, Ordinates is another one. We've had Nanosonics, which is up 5 or 6 times since I originally recommended it at Intelligent Investor in, I think, 2014. These companies are there, and they're always there, and it's our job to find them, and it's our job to hang on to them as they become much larger businesses. And because of the somewhat smaller size of our fund, there's really no excuses for poor performance over a full cycle, but I will definitely be investing in the fund.
We have another question. How will the portfolio deal with governance? You don't know something's rotten until it is exposed. Can you spot it before it is exposed, and will the fund exclude these prior?
Okay, so there's a number of parts to this question, and I think sort of what I was talking about before is I don't want this to be a box ticking exercise. And you're absolutely right, there can be really poor culture in some companies, and the thing we've got to remember is that as investors, we're always outsiders, so we can only question the company and do our best to find these risks before they come and then weigh them up. Sometimes, for example, if you haven't got the right amount of independent directors on the board or something like that, it's definitely not something that's going to tick the box, and it's something you might be concerned about. But if you look at the track record of the CEO, and he's been there for 20 years, made great long-term decisions, runs the balance sheet conservatively and all these types of things, then clearly it doesn't carry the same weight of importance as it does for other businesses. So when we see these risks, we're going to weigh it up as in terms of the whole investment case for the business. We don't want some small anomaly that we might prefer a change to, but doesn't create a huge risk to the investment case. That we don't want to just toss the stock out for that one reason, because it's actually really hard to find great investment opportunities, particularly at this part of the market. So we don't want to chuck a business or investment opportunity out for one small thing that may not have a big impact on the business. And can you just read the first part to me, Sophie, again? Sorry, I'll put Sophie on the spot here.
Hang on,
I know there's another part to that question. I think it was just how we find those things, but yeah. I think a lot of these, I mean, what we're really trying to do is look at a business from, like, it's just because we're going on this ethical side for this fund doesn't mean we haven't been looking at a lot of these risk factors anyway. And this is actually why I think our investment process goes hand in hand with this ethical process, because it's just trying to identify these risks and minimise risks in order to increase our returns. And that's the holy grail of investing, to minimise risk and increase your returns. So we're always looking for bad culture or any sign within the business that something doesn't add up. And unfortunately, you can't spot everything as an outsider. But again, it's just about weighing these things up. And some of these, as I said, some of these risk factors aren't going to be huge, even if they're not perfect in terms of what is the ideal ASX derived governance, sort of set of boards and whatnot. But obviously, if there's big risks, then we want to get on top of those as early as possible. But the best way to minimise those risks is what I've said, is just to find those businesses run by management teams that have got long track records already, and have got a history of producing returns for shareholders in the right way. And you can see, as I said, with Dulux, for example, you can see how seriously they take these environmental aspects and governance issues of their business. It runs right through into management's remuneration. So you might not be able to explicitly see a cultural change or something like that, but you can see it's absolutely chalk and cheese when I see Dulux's annual report compared to other businesses that don't take this stuff seriously. So all we can do is put as many of those factors on our side as possible.
Okay, we have time for one more question, and this is from Robert. He asks, is the fund to be global or certain markets only? Will the same ethical filter be cast over Australia, USA, EU, China, India and emerging markets equally? I have concerns on India, China and some of the emerging market countries.
So I made a last-ditch bid within the company to give me some proportion of the portfolio to invest overseas, given my long experience investing in companies overseas. And I actually have a few stocks that I'm actually really excited about that are listed abroad. Now, unfortunately, we can't get them in this time around, but this will be up for reconsideration in 12 months. And you're absolutely right that the ESG considerations do need to be different in different parts of the world. And my experience in China has been that, for example, you've got these, and this is, I think, a perfect example of what you're talking about. But so there's a company called Baidu, and it's the Google of China. And there's a couple of things that have happened there. So one, the government of China loves its national champions. It really does try to make big winners in its markets that can go abroad and be the winners in global markets. So there's going to be a lot of companies that you probably haven't heard of over the next 10 years that will actually come out to be household names that come from China. And one of those companies is Baidu. And a couple of things it's done which doesn't really tick off these sort of governance factors, if you like. One of them was it essentially eliminated competition. So it made the Google website so slow that it was unusable. So it basically gave the online advertising market, at least through search, online search, it was essentially a monopoly to Baidu until other companies that are similar to Amazon in China have actually started advertising as well. So obviously that's a risk. Another one was that Baidu also recently signed a deal with the government, and the Chinese government last year or the year before was actually looking at taking board seats on the technology companies, because these technology companies are very sensitive for the Chinese government, because essentially they try to have a command and control society. And you may have read about how now people have essentially got these online, all your details online, and essentially if you fail to pay back a bank loan, for example, then all of a sudden you can't get all these other services. And that's a really, let's say, it's interesting way. It's just so un-Westernized, and it's a really different way to think about running a society. But you think about the financial impacts and just the impact it has on individuals, and now that's a very different society. And you've got to ask yourself whether you're even prepared to invest in companies with close ties to the government, given some of these factors. And Baidu is working with, basically what Baidu is famous for is its artificial intelligence, which is used for search, so searching on across the web, and it's also using its technology for driverless cars. And a lot of this artificial intelligence is now being used, and I have no idea how, but in a sense with the government. So I can only imagine that AI, would be used for things like weapons and for the military endeavours. And this is something that we've said we want absolutely zero exposure to in our fund. So I guess the bottom line of that convoluted story was that the governance standards can be very different offshore, and we need to be very careful about what we're looking at. And really, we don't want any of this exposure where possible. And it's obviously a lot easier when this stuff is out there in the public domain, but we just need to be very careful looking at these businesses that governance is something that these companies take seriously. There are some Indian companies that actually report really, really well, have big family foundings in them, and I'd have absolutely no problems investing in them. But India also, once you get away from those bigger blue chips without the good long track records of creating value for shareholders and with all the reporting that goes with that, and also some of these companies are listed abroad, so that they have to comply with more westernized reporting standards. Those companies that are smaller and don't have these things, and have things like auditors you've never heard of, these are big red flags for the portfolio, and we certainly wouldn't be putting the portfolio at risk of those types of businesses.
Perfect. Okay, thanks, Nathan. That's all we have time for today. Once again, head over to www.investsmart.com.au/INES to register your interest or just to find out more. Thank you.